All right, good evening, guys. Kenneth Tortoise Capital Foundation's check-in for Thursday, June 15th, 2023. So there was a question asked. Could I please give an example of what I mean by extreme conditions and clarify further? And I would like to know what to look out for. And below is a copy of Intel's chart from 12 June, which was, let me see, right here. That's 12 June. And that's about the previous 10, yeah, so that's the previous 10 days to here. So I started making a list of the things of what I mean by an extreme condition. And the first thing that I want to say is that extreme conditions help us identify a critical state. A critical state is where we want to be to initiate a trade. A critical state is any condition where there is a higher probability of a larger than normal move in either direction in a shorter than normal period of time. It's like, I probably say that every day. So it's a higher probability than normal of a larger than normal move in either direction in a short period of time. So it's ready to explode. It's like microwave popcorn. Microwave popcorn, once you put it in and starts cooking, it's going to start popping at 45 seconds. And that popping is going to last until 90 seconds. And it's going to have a move in here, and popcorn is going to be popping like crazy. And then most of it is done popping right there. And if you leave it longer than 90 seconds, it's going to burn, and it's worthless. And if you try to eat popcorn before it starts popping, you're going to break your teeth. And they've engineered this thing so that it reliably pops inside this very tight little band. Most of it gets popped right inside here. There's a few that get it started, and the last few that start dwindling. But most of it is within a pretty tight range of time. That's the move. So at 45 seconds, popcorn is in a critical state. It's ready to start popping. So what is it that tells us the equivalent of, hey, 45 seconds has gone by, and now we are entering the zone where this thing is going to have an amazing move in our favor. Too soon and we break our teeth. Too late and we have a burned mess on our hands that smells forever. Critical state. So I started listing the things that I notice for a critical state, and it is literally everything that I say on every nightly podcast and every weekend podcast, and on every coaching chart that I describe when I'm looking for certain signals and conditions that lead to large explosive moves. Well, you could just start with location. And the first thing is yesterday's high and low of the day. So when today's bar looks like this, then you can set up an automatic trade frame that says, look at any breakout above yesterday's high is significant. So that is a zone where you're going to get big moves in either direction. Why? Because yesterday the forces of buying and selling compressed it or contained it within that range. So tomorrow, any price action that's in the yellow zone is going to be normal, because that is no change from the previous day. The first time you know that something absurd might happen is it has to break out above the price that they couldn't get it past yesterday in either direction. So if I were to now take a look at this yellow zone in here, and say, look, in general, that price action in here has no new information about what compared to what yesterday offered. Check or hold. But it's the violation of that means something special just happened. So what could I do to look for an abnormal condition or an extreme condition or a critical state? Well, the first thing that I can do is notice if price opened right where it closed yesterday, that is the very definition of normal. There was no news in the overnight session that caused price to change at all in 16 hours. That is the absence of a critical state. But if I take a look at the top 10% and the bottom 10% of that zone, I notice that if price starts moving up in this direction, it is approaching a critical state. Because at that critical state, it has to do one of two things. And I don't know what it's going to do. And that makes me nervous. And that makes everybody who's paying attention to it nervous. That makes them all nervous. They don't know what's going on in here. It's either going to return or it's going to break out. If it breaks out, that means there was new buyers coming in and they're going to push it higher. And I don't know how many buyers there are, but if there's more buyers today than there were yesterday, that simple fact is going to be alerted by a breakout, and that may cause more of their friends to come. Everybody that's trading momentum gets triggered by a breakout, and some number of them are going to come. I have no idea how many that could be, but if you're trading large caps, there's a whole universe of guys over here with tons of money that are waiting to find breakouts so they can do something with it. Now, if it breaks out from here, what's this pool of buyers going to do? Well, some of them want to come in and push that thing higher. And off it goes until they run out of money. Maybe that, I don't know, is that half of them? Could be. What are the other? So those are all the buyers that get triggered. Well, what about all these other guys? These guys run over and say, oh, after these guys have had their false breakout, I'm going to come back and pound it back into yesterday's range. So these are the guys that are coming over and selling. The simple fact that it was a breakout above yesterday's high is new information that puts it in a critical state. It's in an extreme condition because you got this mad rush of guys that were sleeping or looking at other symbols. They were looking at all those other trades that were happening, and suddenly this breaks out. They come thunder running over here, and it's going to be an explosive move up or an explosive move up, then down, or whatever it could be. Because we don't know what that's going to be, that is the very definition of a critical state. It's all the old money plus all the new money and all their psychology and all the rules that are going to trigger their entries and exits. That's why a breakout above yesterday's high of the day is a critical state. Check or hold. Now, what I just said, same thing on the bottom, only even more so. Well, why is that? Because this is a trigger of fear. That triggers fear. And that is 3 times more powerful than all the enthusiasm of breakout to the upside. So, if I see this thing opening here and it starts moving towards that, I am double interested in this. Because I know that if it breaks through that little barrier, engaging fear now, and off it runs. So when I look at the yellow zone, I can take a look at those, that upper and lower 10% of the daily range and be ready to take advantage of explosive moves. That's what I mean by a critical state. Now, if I'm taking a look at that range of price in the yellow zone, notice that it is at the extreme conditions. Where amazing things can happen. It is movements that start in these critical states are the ones that have the highest probability of larger than normal moves in either direction in short periods of time. This thing is either going to explode up or it's going to reject immediately, and this one is either going to collapse immediately or it's going to bounce and go up. It is almost unheard of for it to come up right to yesterday's high and low, and then suddenly everybody decides, that's the new correct price. I mean, it could happen. But if you're playing for a continuation and it doesn't happen, you don't lose much money or anything because it's not moving. But if it gets to an extreme condition where it broke through yesterday's low, you get a move and then the recovery. And here was the previous day's high right here, and then on the 12th it breaks out and goes. And this is nice because it's not just the 1 day look back. If you go back through the 10 days, this is also the 10-day high. So when it's at this location right here, this is double good because it's not only the 1 day high of the day, which I just described why that's cool, it's also a 10-day. It's also the 10-day, and now everybody that's going to be triggered by a breakout from there are going to run over and play. And everybody that's over here waiting to play because it broke out of yesterday's high is coming to play. There's a whole pile of dudes coming over. So the very first thing that I will say alerts me to critical states and abnormal conditions is literally a breakout of the high of the day and the low of the day. Check or hold. Good. Now, let's look at the 3 time frames of the sniper. 10 bar, 30 bar, 150 bar. Now, normally you see me talking about that on daily charts. So every day I look at all 500 symbols in the S&P 500 and I identify the ones that are in extreme conditions of overbought and oversold on more than one of those things. So the sniper system itself, just on the basis of trade location, is identifying 3 different time frames that have all come together at once to signal that this thing is in a critical state. So that's one way that you could find out what's in a critical state, is you can look at that. Now, it turns out that this 10, 30, 150 as a tactical, operational, and strategic time frame, it's not just daily, it's also on any time frame, because it's the relationship, it's the fractal relationship between those 3 considerably different time frames that shows 3 different pools of traders all coming together for their own reasons, and then they're all prepared to surprise each other. Because most of the time, that one guy who's just working on one time frame, he sees this thing coming up to a breakout, and he wonders, is this going to be the one where it breaks out, or is that going to be the one where it fails? So he's used to trading that. And that's the only thing he's looking at. On his screen, all he sees is this time frame. Hey, but there's these other guys from the 30 and guys from the 150 that this guy on the 10 doesn't even see because he's fixated on this. And now suddenly, when you have a compound critical state from location, you suddenly got 3 to 10 times as many guys all rushing in to play that breakout, and boom goes the dynamite. And now all 3 of them are surprised because none of them was expecting that, because they're all working at their own time frames. So compound time frame analysis gives you insights into something that are in extremely critical states. It's a compound effect of multiple time frames or multiple patterns or volatility or market conditions or the sector or the pattern or any lens or any statistical treatment. The more of these things that start firing, you start getting a compound effect that creates a more and more critical state. So when you use the multi-lens, multi-time frame analysis, and you're looking at 5 different lenses independently, you're now starting to see 5 different bodies of knowledge that are all looking at this one little critical state and saying, wow, that thing is ready and poised to blow up simply because of its near support and resistance. And this guy says, oh, this is an RLCO pattern that's getting ready to fire. And this guy says, oh yeah, that's a regression line fractal framework pattern. Yeah, and this guy says it's a MACD histogram critical state because it's below the Red River and it just went from winter to spring or something like that. And this one might have been any pattern from any of our traditional symbols. So if more than one of those is firing, and identifying a critical state, you actually have the compound effect, and it multiplies. So what, I got to do that all the time? Well, no, you don't have to do that all the time. You could simply take a look at something like the auto framer, which I have said on the daily report is my default lens for looking at tomorrow's trades. The auto framer uses the following things. It takes a 10-day high. It takes today's closed range, and it treats that as 1R, and it simply says, suppose this thing opens inside tomorrow's yellow zone. So this is today. At the close, that's day -1 when it opens tomorrow. And so on today, if that thing is in the yellow zone, and I just get a mechanical entry, so it opens anywhere in here, and then it breaks out from here, if I then say my entry is here and that's my 1R risk, how many of those 1R risks are available back to the 10-day high? And that's a standard piece of work for a swing trade. Well, I can express this as the reward, and I can express that as the risk. And the larger the reward to risk, the better that trade is if it breaks out of that auto frame. Now, how do you get a large reward to risk ratio? Well, there's 2 ways. You could have a very large reward. In other words, this thing sold off a ton from the 10-day high. That's one way to get a large reward. It's fallen so far from the 10-day high. Oh, you also know that I do that when I say max pain range compression, which is simply just another way to say the auto framer. Except it is very explicit about what has fallen the furthest. And then the second way I can get a large multiple is have yesterday's range absolutely compressed into a very tight box. So if I have a very small box, it could make a normal sell-off look really favorable simply because the risk is so small. But you know what the best possible condition is? When I have the maximum pain, so the reward is large, and I have the smallest risk because of range compression. The combination of those 2 things makes the MPRC extraordinary. And those are the ones that you see on the auto framer have reward to risk ratios better than 2 to 1, which is why I highlight them. But you'll also know that I say I have a list of which ones are in min pain, and those are the ones that have fallen the least from their 10-day high. And I also have which ones are in the max pain. Those are the ones that have fallen the most from their 10-day high. All other things being equal, if I took a look at all the symbols that I have and I just measured how far they fell from their 10-day high, the ones that are the min pain are interesting because they're an anomaly. They are the ones that have, out of all the symbols that I track, they have fallen the smallest percentage of their price from their 10-day high. That's one way to look at relative strength. Relative strength is a way to find an extreme condition. And then also, the ones that have fallen the most from their 10-day high are in max pain. And so you see me look at the 5 symbols every night. On page 1 of the dashboard number 1 has the 5 symbols in the Dow and the 5 symbols in the ETF that are min pain and max pain. And then you also see me highlight the ones that are better than 2 to 1 on the auto framer. And then you also see me show which ones are at super pinch. Those are the ones that are pinched extremely narrowly, abnormally tightly pinched. So all of those are ways to find out extreme conditions based on the amount of pain, the amount of volatility. They are expressed simply in the auto framer and the max pain range compression. And that's another way to do it, to find extreme conditions simply on the basis of location. Check or hold. I say that every night in the first 3 pages of the review of the daily report. Well, I also take a look at volatility. And the only volatility that I care about, if I went back 30 days, and I could measure its relative volatility compared to a 100-day look back. So what I do is I calculate what was the range of each of the last 100 days, range divided by price equals volatility percentage. And then I could rank those on the scale of the smallest percentage to the largest percentage. And I could find the average percentage, and I could go plus or minus 1 standard deviation. And I could call all of this normal. And I could call this extremely volatile, and I could call this extremely quiet. Now, 2/3 of the data is going to be in the normal, and only 1/6 is going to be volatile or quiet. Guess which ones are extreme? Extreme quiet and extreme volatile. Now, why is there a large price move out of those conditions compared to the normal volatility? Because nothing special has been happening inside here. But when it's quiet, that means this thing went way up and then suddenly got really, really quiet into a tiny little doji. That tiny little doji is like an acorn ready to explode this way or that way. So the absence of volatility is an alert that this thing is in an abnormal condition. That is a critical state. That is abnormal. It's extremely quiet. Hey, what about on this day over here where that thing had the largest volatility of all of the last 100 days? Oh, well, that's really amazing because suddenly it blew up. That means tomorrow there's either going to be a continuation on all the surprising news, Or all those guys are going to come over and say, well, that was a head fake, and they're going to smash it down. So the fact that there is extreme volatility already tells you that it's in play and it's in an abnormal condition. So volatility just by itself can tell you that you have an extreme condition. Guess what happens when you put together location, compound location, and volatility? You get the sniper. The sniper system is triggering on things that are extreme based on location from more than one time frame and based on volatility. That thing is radioactive, ready to explode. Now, there are certain patterns that I have that we talk about, like the Z3 pinch and the super pinch. Both of those are generation 2 RLCOs. And what that means is that when price went zooming up and then starts to decay, the Z3 lines in the Bollinger Band initially got very, very wide because of that extreme move up. And then it started to decay, and now the Z3 lines are starting to pinch. At some point, this goes sideways enough that we would say, oh, it stopped moving up. This is now in a sideways quiet channel. And if you're trading inside of a sideways quiet channel, you're going to get slaughtered by the crocodiles. You cannot trade in a sideways quiet channel. What you can do is you can wait for it to get outside of the Z3 lines and trade it, because it has now moved to an extreme condition. If you are skilled, you might also look at the Z2 and minus Z2 and trade the breakouts from Z2. You can actually trade from Z2 to Z2 as well. But most of the time, stay out of the sideways quiet channel, because the crocodiles will eat you alive. But what happens if you get, if that thing, if it does this, and now price, which was extreme, has now started to chop around and starts getting like this, and you said, yep, I noticed a sideways quiet channel, and I notice that the Z3 lines are still outside of one frog box. That is danger, because that's the sideways quiet channel that'll kill you. And all those crocodiles are sitting on the Bollinger Band mean, and they are eating you alive, because price is just moving around like this, and everything you're trading every RLXD and every reversal, and you're getting chewed up inside the river because you're not paying attention to where the Z3 lines are. But when this thing, that frog box, which is constant for the whole day, because it's based on the last 30 days of range, the last 30 days range standard deviation equals the frog box. So that means for the entire day, that is a constant number. And we know that the range stat is the average range plus one standard deviation, and that tells you the maximum reasonable intraday move, and that's usually 3 to 4 frog boxes from the low of the day to the high of the day. Well, so if I know what the frog box is, and I can use that to calibrate, I should have the frog box on my screen every day that I am trading live. And then when the Z3 lines come inside of one frog box, I now have an abnormal condition. I have an extreme condition. What I have is a Z3 pinch. Because I am in a sideways quiet channel, it's being contained by a frog box, and the Z3 lines have all come inside the frog box. This thing is now compressed and ready to explode. Now I can trade that. That is an extreme condition. Oh, what if I then get a super pinch? Well, a super pinch consists of, first, a Z3 pinch occurred. So both of the Z3 Bollinger Bands have compressed inside a single frog box. Check or hold. Just show me a thumbs up. Good. Now I'm going to bring in a completely different analysis, the moving regression lines. And there are 4 of them. There is the RL 270, which is the long-term buy and holders fair value. There is the RL10, which is the trader's price. There is the RL30, which is the health of the market. And there is the RL90, which is the health of the next higher time frame. And those are fractal on the basis of the powers of 3. Now, the biggest difference of opinion that I'm looking for when I'm just trading RLFF, and this was Brian's question, whether or not he should add the RLFF. So not even thinking about the Z3 pinch yet. But if I go and just look at the 2 extremes, I look at the RL270 and the RL10, I'm going to take a look at the energetic young traders price, which is the RL10, and I'm going to look at the old, fat, lazy, tired, long-term buy and holders, the RL270 fair value, and there's 2 times when this is in a critical state. One time is when they are both at the same location. And when both of those are so tight that you couldn't even get a knife blade between them, then for one magical moment, both the long-term buy and holders and the traders both agree that this is the fair price. Now, how long can it stay there? Either forever or until the traders decide to start moving it on the next reason because of news or just to see what's happening, or who knows. But the traders have started to move that a certain distance. Now, because of math, it takes a lot of price action for the RL270 to move. So the first time the traders start moving it, it doesn't even budge the 270. And then at some point, I notice that there is a divergence between what the traders say is the fair price and what the RL270 guys say is the long-term fair value. How far can that stretch from the traders to the holders? How far can that stretch? It depends on how much money the traders have, and this is a measure of how much power that they have to move price away from the consensus agreement. So I can now go backwards in time, and I can measure what was the size of the difference between the RL10 and the RL270, and I can go from min to max, and I can find the average, and I can find the standard deviation, and then I can say this is hardly different at all when it's more than one standard deviation below that. That is consensus. That's what this looks like. And if I go out here, more than one standard deviation, this is a fight between the traders and the long-term buy and holders, or it's the other way around, because they moved at a significant difference. So what I can do is, if I know that this is an abnormal stretch between the RL270 and the RL10, I can now start measuring that and marking it off in terms of units of reward and risk. And then if it exceeds, I don't know, 4-to-1, 5-to-1, I could use a reversion. I could call that my risk. And once that gap starts closing again, well, actually it goes this way, because the traders will come back, I now have a favorable reward to risk ratio. So now let me put all of this RLFF together. This whole theory of the extremes of the 270 and the 10, that in and of itself is its own lens, and I can frame swing trades on that all day for the rest of my life. I do that all the time, looking at daily, weekly, monthly, 3-day and 9-day charts, because it jumps out at you. You can't even not see it. And the greater that difference, the larger the potential reversal move is. The reversion back to the RL270. On a weekly basis, you could do that just by measuring the number of ATR boxes and decide how many ATRs you want as your risk. If it's 2, then it has to be 8 ATRs away to be justified as a 4-to-1. Oh, so now I'm coming back over here to the Z3 pinch. And now I remember that what has happened is that the price has now compressed in that sideways quiet channel, which is terrible for trading. That sideways quiet channel in here will get you killed because that's where the alligators live. But when it compresses inside of the frog box, I now have a favorable condition of a Z3 pinch. And the reason that's favorable is because the alligators are tired of eating everybody and they're asleep. And then the traders have forgotten what it's like to get chewed up, and then the next breakout can be large, or the breakdown can be large, or sometimes it's a fake 1 and go 2. So any of those things can happen coming from a Z3 pinch. And that's why a Z3 pinch is great. Checker hold. Yeah, so Z3 pinch is good for us. Z3P is good because the breakouts in either direction are good, and I stay with it. I don't take one try and then, well, it failed. No. Fake 1, go 2. I'm always ready to pile on simply because that Z3 pinch has compressed all of the energy that was involved here into a tiny little acorn that's going to be amazing. But that's not even the best one. The super pinch happens when I have a Z3 pinch plus all 4 of the regression lines have also moved in to that same tight frog box pinch. That means that the RL270 is inside that box. It means the RL10 has come into that box. It means the RL90 has come into that box. And it means the RL30 has moved into that box. When you see a super pinch, you can barely even see the price because everything is so compressed and clustered in there that now everybody agrees not only is that extremely pinched, but everybody agrees that that is the current correct price. And so a super pinch is the best money of all. That thing is like a little acorn just ready to explode. It's a special case of the Z3 pinch. And if you ever see a super pinch on swing time frames, you better be ready to trade that for the next 6 months, because it's going to take that long for it to unfold in multiple legs. So, on the basis of volatility and now kind of location, I get those. Hey, guess what? I look at the market classification every day, the very first thing on dashboard number 1. So any volatile condition is automatically interesting because of volatility. Any bear is always interesting because of fear. I also can look at the statistics of the RL30 slope. I can look at the percent stretch away from the 200-day moving average. I look at the relationship between the slope of the 10, 30, and 90, because sometimes those compound and get to be interesting, or one or more of them is at an extreme condition and has started to turn, and that means the truth just was about to change. And then I can take a look at the asset class comparison to see, are stocks better than bonds? Is gold better than commodities? Which asset class is crushing it, so I can be in the right market? I can take a look intraday at the VWAP magnet. I can say, look, the intraday move from the opening, here's where it opened, and that thing has been amazing. It did all of that. And the VWAP is way down here. And now we're in the last 2 hours of the day, and this thing has started to peak, and now here's where the close is. And guess what? Guess where the VWAP is going to be? The VWAP is going to be approximately where it is now. And that's going to be the price that they settle on for long-term traders between their brokers and the mutual funds. They settle up each day on the basis of how much did I pay above or below the VWAP on average for all that large position that I paid you to put on. So the guys that moved price way up are doing that because they have leverage. And they are smashing that thing north and north and north and north. And now they realize, the end of the day is coming, and I've got to unwind my leverage. And so all of the guys that were buying are now sellers. And so it's not unusual to see in the last hour that price to move from here like a beeline back to the VWAP. So if you're looking at the intraday chart and you notice a big difference between current price and the VWAP, that's an extreme condition if you notice it. And then when you put a time frame on it, say, hey, I got 1 hour left, dude, you better pay attention to that, because the last hour by definition is an extreme condition. Why? Because everybody's unleveraging their positions. So you could have had a big run up in the morning and then nothing, and then suddenly in the last hour it crashes. Why? Because they're getting rid of the leverage. They couldn't push it any higher, and now they got to get out of that position. So if you had a big run up during the day that got your attention, that is also extreme. How do you know if that's extreme? Well, you could put the range stat on it and say, how much of a range stat was that move? Was that 80% of a range stat? That's a pretty good move. Was that bigger than the average range and it's already just noon? That's already an extreme condition. So not only should you have the frog box on your chart, you should also have the range stat so that you can calibrate the size of the move and tell the difference between normal and abnormal. That's something that you can do. From the weekend report, you can take a look at the sector comparisons, where I take a look at the market conditions and I compare index performance in ETF2. And I say, hey, what's the difference between the US and the globals? And what's the difference between the Qs, the S&P, the mid caps, the small caps? You see me doing that, and DIA. You see me doing that all the time. And what's the difference between Europe, Japan, Asia less Japan, the Euro-Asia blend, and emerging markets? So I can see which of those 10 indexes are extreme. I can rank those and say, I'm very interested in the top 2 and the bottom 2. Or I'm very interested in anything that is in the green compared to their peer group, or anything that's in the red, anything that's in the red compared to their peer group, because those are extreme. And then in the middle, I have slightly below average is yellow and slightly above average is white. So I've got 4 different classification strategies, but the ones that are at an extreme are green or red by any measure. So you can use that. You could take a look at the chart where I am comparing weekly, monthly, 3-month, 6-month performances, and then I rank everything according to their relative performance to their peer groups. And you see me use 4 different color code categorizations. You see me using green, and you see me using red, because these are more than 1 standard deviation below average, and you see me having a bunch that are in yellow. So if you saw something that was green across the board, that thing is in double, triple, quadruple greatness. If you saw something that was green on a weekly and above average on a monthly and below average on 3 months and horrible on 6 months, you know that that thing has sold off hard and is now slowly coming up, and now it's starting to accelerate. So just the difference in his categories based on time frame can tell you that something was different. Just the difference between a color code between 1 week and 1 month, that right there, green and white, is an extreme condition. I even put that on the weekly chart so you can see that that is a high priority, because what was above average has now become great. What was good has now become great, and it may be taking off. So that's a way to do it. You could take a look at stocks compared to their sector. Hey, tech is bad and semiconductors are double bad, but NVIDIA is great. Well, that's extreme. It is great when its sector and the broader tech sector is horrible. Just the difference in that could indicate an extreme condition. Or you could say, hey, tech is great, the semis are great, but NVIDIA is super, and Texas Instruments is average, and Intel is terrible. This could be Texas Instruments, and this could be NVIDIA, which is what it is right now. So you could make a decision, I want to go with NVIDIA because I want to ride the winner while he's hot. Or, no, I want to ride Intel because it is underperforming, and yet it could be great as it plays catch-up. So extreme conditions can come from multiple locations. You could take a look at any pattern that we have. I talked about MPRC and the auto framer, but any mechanical swing pattern is in an extreme condition because they don't always fire. But when they do, that means that inside that trigger, that a bunch of things came together that made it an exceptionally good idea to be ready for a alongside swing pattern for the next 3 to 5 days. That means that any mechanical swing pattern is a critical state. Any sniper pattern, any generation 2 RLCO pattern that you see me doing every night on the hybrid time frame. Looking at the 30-minute chart and taking a look at just the Gen 2 swing patterns, an owl pattern, an SQC, a Kata 2, a collapsing dragon. When I see things coming into the zone where a breakdown below this price level is going to be a collapsing dragon, and a breakout above this level on the PSAR flip could be an SSC, that is a critical state. So if it was preceded by a harsh winter, how could I figure out if there's a harsh winter? I could go look at the MACD. So a MACD that is in the winter and out of the Red River is automatically an extreme condition. I could simply take a look at the winners and losers at the end of each day. You see me doing that when I say, look, here is the Here's the S&P's performance. Here was the maximum good, and here was the worst, and here's the S&P. And then what do I do every day? I say, here is Tesla. And for the last 90 days, Tesla has been better than the S&P. It's the most important stock in the world. And that has had a 40% gain in the last 30 days, and it's always been better than the S&P. And then I draw a blue line in there and say, look, here's the difference between winners and losers. So anything north of the winning line is good. Anything below that is bad. And then I say, look at the here are the three metals. I look at Alcoa and Cliff, and so I look at Alcoa and Cliff, and what's the other one I look at? U.S. Steel. Oh, U.S. Steel was near the top, and it was better than Cliff and better than Alcoa and better than the S&P. Daggone it, that thing is great. And if I just look at, and I could look at Devon Energy, and I look at the three semiconductors. So just by looking at the array of daily performance, I'm always interested in the ones that are near the top and all the ones that are near the bottom, because that's the big winning news of the day, and there's either going to be more of that or it's going to revert. And all the ones that were big losers are either going to be, value buyers are going to drive it up, or fearmongers are going to panic and run away and it's going to get crushed. And then when you see things like the metals and the semiconductors, those things cycle routinely. So when they are at the bottom of the list, I'm already ready to trade them long. Or if they're at the top of the list, I'm ready to trade them short. Intraday, anything that has moved a fail stat or a gain stat and starts to so if it moves a fail stat and starts to reverse, extreme condition. If it's moved a gain stat and starts to fail, extreme condition. If it's moved a range stat, extreme condition. Literally, everything that I am talking about on the daily and weekend report is me noticing all of these things that are creating extreme conditions so I can find a critical state. That's all I do. Now, I do so much of it that it comes at it like a shotgun and word salad. So that's why you've got to focus on some things that are working. You got to try them and see what's resonating and then become deaf on those. Now, here's what this person gave me on Intel on the 12th. Now, first of all, I can barely see because of all the darkness in there. God dang it. That's hard. So here's the 12th. Here's what it looked like on the 12th on my screen. Every blue circle was a critical state. Every one of them. It just broke below the zero line, as in the winter, below the Red River. Guess what happened from here? Smashed. Here it went into spring for a moment and then went back into the winter. Smash. Here's where it went from winter to spring below the Red River. Oh, SSC. Smash. It crossed from spring into the summer. Smash. Here's where it went from summer to fall. Caution. It could either be great or a collapse. Oh, it turned out to be great. Here's where it finally rolled over again the second time. Oh, now it returned. Here's where it went through the Red River into the fall. Warning, sideways quiet channel. Here's where it went into the winter. Smash. Here's where it went into the spring and then in the summer. Smash. And here's where it was on 12 June on the big gap up. Notice it had dipped into the winter and immediately came right back up, and it gave a big gap breakout, and it broke above the previous RL10. That's an instantaneous buy right here. See that big red circle? That's where that's where the buy signal is on 12 June, which was Monday. Here's 12 June. That Monday, that big red circle was right here. See where it broke above this and broke above that? And the big gap up, and it went back into the summer. That's what happened from that critical state. Only back here, not that one. Is it this one? Yeah. Yeah, back here, this doesn't look all that amazing. And it was actually near the top of its 10-day range. And here's the bottom of the 10-day range and the 30-day range. It's in that upper level and a breakout. So it's either going to do this or it could do that. And now when we get here, we notice, okay, it did this. It did that. And now here's where it went. Summer, fall, summer. Critical state. It was worth a shot. It didn't follow through. So you get out at the PSAR because of reasons. These are potential. This is reasons. When that thing violates, that's the Great Wall right there. You got all these reasons to be excited and enjoyable. Yeah, awesome. When that breaks, change your mind. So it went summer, fall, started in the summer, so I put the second position on, and it was better than the RL10 peak. It failed. Up, it went into the fall and then went back into the summer. Same pattern, only this time it worked. Leg 1, leg 2, and here is where I should have gotten out. Maybe I did. We have to look at today's pattern.
Ken, can I ask a quick question?
Hurry.
Are you changing your exit algorithm from the Dragon to the PSAR based on the MACD?
It works out to be that way. Because one thing, what you'll notice over time when you start hanging into these things, you'll get some SQC or SSC, and it'll go big leg 1, pause, smaller leg 2. When that happens, the MACD is already kind of rolling over. Because this is a simplified version of all the noisy moves up in here. And when that thing rolls over from, and if that's the demarcation, summer and then fall, it's kind of, this thing is supposed to go up, and then the PSAR is accelerating, and the Dragon's going to be in there somewhere. But if you notice, hey, leg 2, it's leg 1 and then leg 2, and it's like, dude, you better get going or it's, where's everybody else? If it was just a bunch of tactical guys that were buying, and then the operational level and the strategic level guys, you know, the RL90s and the RL270s, if these guys don't come in and start buying that, then all of the 10 and the 30s are what brought it up to here, and then these guys don't come in, there's nobody left to buy. And then it just peters out, and then the traders start bailing, and then that generates momentum. So you get this leg 1, leg 2, collapse, and then a big collapse. So you got to be mindful of what's the size of those moves. You'll see that reflected in the MACD, but you'll also just notice that the damn PSAR, because it has a certain standard acceleration, it will time you. It gives it a certain amount of time to get going, and if it doesn't, that PSAR really, really helps you at the end of that successful trade so that you don't fall in love with it and talk yourself into staying longer. I hope I always get out and then get right back in when it starts up right after I get out. I hope that happens. Here's a flashcard. Flashcard_pinch. Find that in the chat room. And that covers how to do it on intraday and then on the swing. On the swing, you're essentially using either one ATR or as many as two. Somewhere in there, the size of your wrist box is enough that when you see the RL10 and the RL270 is up here, and you say, look, I got 1, 2, 3 boxes. If this was ATR, that means it was four ATR from where the price is to the 270. And now I get a 3-to-1 frame. So price sells off here, bottoms out, it moves a full ATR off the bottom. I got 1, 2, 3 to the upside. Or if you're doing a swing trade, maybe this is 2 ATRs. And that means this has to be 6 ATRs to the upside so that you have 3-to-1. Right? And then you let it move on a swing basis, 2 ATRs off the bottom, 1, 2, and then you buy it, and now you have a reasonable expectation that it could move 6 ATR just to get back to the 270. That's the absolute essence of reversion to the mean trading on longer term. Only in this case, we're using the return to the 270 as the mean. Most of the guys look at the mean as a simple moving average. But we're using the regression line, which is better as a moving average. And nobody else on the planet is using the 270 because nobody else has figured out that the fractal nature of 10 to 30 to 90 to 270 allows us to see 4 distinct time frames on a single chart and can measure extreme moves. So remember, there's 2 extreme conditions there. RL10 and RL270 are closely connected. And then the price breaks down and moves some distance and then starts to revert. And the RL270 is slowly decaying, but there is still this move from here to here is so far that now that it's moved a 1 or 2 ATR off the bottom, I can now project and say, look, there's 2, 4, 6 ATRs going forward, and I know that this thing is going to decay, and I know it's going to take time for this to go, so they're going to meet up here in the next time that price and the RL270 come together. Check or hold? And then the size of the move from the 270 to the maximum excursion, I can now come over here and say, you know what? From the time that it crosses over again, I can measure that same maximum excursion from the last time, and I can say that this is how far this thing, it could move to here on leg 1 and then move that distance to leg 2, because that's how far the traders could move it this way. Because guess who moved it? Guess who moved it from here to here? The traders. Plus all of the RL270 guys who were buying it on a dip. So now you got traders and long-term buy and holders both pushing it back to here. Do you think they're going to stop right there? No, they are not. They're going to take it back to this. And the size of that move predicts the size of this move. And now you can use support and resistance to estimate how far beyond the 270 that thing can go. So if it gets back to the 270, it ain't over yet. Now here's the other thing that's cool, is you got the RL10 has moved it down to here. You can actually use now the RL90, which is the green one. That's an intermediate term. And now what you can do is you can set that up as, here's where it started to turn around, so that's where I bought it. And here's the first target that's crossing the 90, and here's the second target where it crosses the 270, and here is the third target where it gets back to where it failed. Guess where this is in the S&P? That's at 470. That thing sold off as low as 360. It's now back to 430. So there's another $30 or $40 to the upside. There's another 10% move just to the back of the previous all-time high. So now I can use this as a strategy to start calibrating the size of moves over time. And I can use the regression lines to start mapping out my adaptive, adjusting price ladder, which accounts for how fast is it moving, how slow is it moving. All of that leads together into the multi-time frame, multi-lens analysis, which looks at support and resistance, MACD, RLCO patterns, RLFF, something else. I can't even remember what the other one is now. I think it's the standard swing patterns. So each one of those is a lens, and when you start getting multiples firing together, you get the compound effect. And so now if you have this in your mind as something like just a little dashboard of criticality. And as I'm going through the charts and the daily reports, all I'm really doing is saying, yeah, there's the high and the low of the day. That one fired, and it was the slope was this, and the auto framer says that, and the sniper says this. And I start putting multiples together. And then when there's a bunch of things that are all firing on Brazil, then it's Brazil. And if there's a bunch of things firing on Intel, and it has it's a sniper, and the MACD is just right, and it has a great trading value, the next morning it gaps down and sells off a fail stat and starts to reverse, and then I can just get a 1, 2, 3 entry on a really tight risk box. That's an automatic, because it fell so far that if it actually violates where I bought it, if I buy it here, and instead of going up, that thing just goes up a little bit and then fails, I'm so short right there, it'll make your head spin. So you can start compounding these different little indicators of what constitutes an extreme condition. Now, Brian, I tried to answer your question about the RLFF. For your purposes, what I would do is I would add the RL270, and I would add the RL10 so that you could get the two extreme conditions, so that you could count how many risk boxes are between those to see if you have a condition. And it better be 5. It's 5. Now, if they are both together, then there's probably easily, if that's a risk box, there's at least 5 boxes if the RL10 breaks out and goes. So there's an implied 5R when those things are tightly packed. But once it unpacks, if this thing gets up here and starts to turn, and the RL270 is still down here and is just starting maybe to get better, and I have this I have my little frame, I want to see 4 down to the 270. Then if I only get half, I still get 2 to 1. Leg 1, leg 2. And then I'll still, if I get 1R, I ain't losing money on that trade. And a 4R lets me get 4R. And if I only get half of that, I get 2. And if I only get half of that, I get 1. That's the odds I like. So the power of 5. Now, intraday, that could be 5 MMRBs or RL10s. Why is that good? Because the range stat says that there's 10. So if I could see just half, if I get 1 unit of risk and I got 4 just to the mid, there's my 5. And it might go all the way to the range stat. But I can make money on that forever and ever, amen. If it's a swing trade, instead of the RL10, my MMRB is probably either 1 ATR or as much as 2 ATRs. But not more than 3. So I would start with 2 ATRs as your standard unit of risk on a swing trade, so that you start with 2 ATR. If that's too big, you could scale it down to 1. If that's too tight, you could scale it up to 3. So start with 2 and either tighten it up to 1 or increase it to 3, and you'll find all the swing trades that you can handle just on the basis of the difference between the RL10s and the RL270. When those things get more than 10 ATRs away, that was such a huge move away from the previous normal that it's a new day, and it gets to be very interesting. Okay, all right, that's everything I got for today. I got to get this published and posted. Brian, let me know if that didn't answer your question or if you need more clarification. But that's what I mean about extreme conditions and critical states. It's easy to miss that because of you're paying attention to details so much and wanting to be precise, and that's good. But sometimes we got to step way back out and look at the much larger picture and then realize that our skill, our edge, consists of the ability to zoom in and zoom out with equal adeptness. Like, we don't get locked into one time frame exclusively. We're able to go higher time frame and lower time frame. That's why I like the 30-minute, because I can move out to the daily or the 3-day or the 9-day, or I can go down to the 3 or the 1 minute. So to me, the 30-minute is in the sweet spot. I can go up 2 or 3 levels. I can go down 2 or 3 levels. And it's the same fractal patterns. All right, that's everything I got. See you soon. Hey, Greg, if you're going to be in there, let them know 8:45. I got 19 minutes to get my stuff together. All right, cheers.